much better, y'all. All right, so I'm officially going live from the other platforms. Hey, everybody. So we're going to be talking about this crazy behind stock market today because it's acting wild. So we got to talk about it. We talk about what's going on with the market. We talk about things you can be doing to position yourself in the market right now, because I've gotten so many requests from newbie investors who are like, okay, what's going on? Do I wait? Do I buy? How do I position myself? So we're going to talk about that tonight. Okay. All right. So first things first, the S&P and the S&P 500 and the Dow, okay, have seen some significant surges in the past 2 days. Matter of fact, the S&P 500 has gone up so much that it's seen its strongest surge since April of 2020. Okay, so the S&P 500 has gone up 3% in the past 2 days, and the Dow has gone up 2.8% in the past 2 days. Now, why is this significant? Well, you would look at this and you would say, oh, dang, okay, all right, our economy must be turning around. This has to be what's going on. We must have some good data that's being reported for the market to look like this. Well, if you guys went and you looked at my last reel that I posted, I'm real big about looking at things from like a close-up perspective, and then we need to look at it from a kind of like draw it out and look at it from a long-term perspective, right? So short term, we're looking at the Dow, we're looking at the S&P 500. They look great within the past 2 days. I mean, they look like they're booming. Now, if we just dial those back and we look at the S&P 500 from year to date, I'm talking about last year until today's date, right? We can see that the market has been on a steady decline since last year. Okay, so all of these mini rallies that we're seeing, rallies meaning turns to the upside, meaning like, oh, okay, it looks like the market might be correcting itself, but it's not. And I was actually reading some research, and I don't want to misgive the term on this, but there was some data research that was done, and essentially they were suggesting that the only times that the S&P 500 has seen rallies of 2% or greater has been in times when the market has been stressed, where it's trying to do this like abrupt turnaround, like trying to give it its last push before it continues to go further down. So the way I like to look at this is, I don't know if y'all ever got into school fights when y'all were kids, but this is how I like to look at this. Let's say you've been getting your butt beat the whole fight. And then you're like, you know what? I got to get my last gust of strength up. I have to get up off this ground. I have to get it together because I can't lose like this, right? And then you, in your weakest state, you fight your way back up only to be knocked down again. That is essentially what's happening with the market. Okay, so we're seeing these rallies, these short-term pushes that the market it's in a very weak stance right now, but it's trying its best to give it a last go. And traditionally, September is a red month, and October is a month where you do start seeing turnarounds in the market. But with inflation being as high as it is, and from a world economic standpoint, y'all, these other countries, these poorer countries, are already being affected by $360 billion on what they're able to produce. So because of all of these interest rates that are going, because of inflation, it's not just the US that's being affected. There's world economic damage that is happening because of everything that is going on. So it's not just to say, oh, this is a stock issue. It's not just to say this is the S&P 500 issue or a Dow issue or what have you. It's not only a US issue, it's causing problems economically. Okay. I'm sorry. It's causing problems all over the world. So what you can do when you're saying like, okay, well, sis, do I wait to position myself in the market? Like, are we preparing for a recession? We're already in, by traditional definition, we are already in a recession. We all know that, right? So it's not so much are we preparing for a recession, we're already here. It's trying to not, in my personal opinion, y'all can argue with me if you want to, in my personal opinion, is we're trying to fight our way from hitting a economic depression. That's a personal opinion. Y'all can fight with me on that if you want to, but just from what I'm seeing, it's being strongly encouraged by the UN that the US not go over 5% with its interest rates, because at that point it will start causing some catastrophic things, just not only for the US, but again for other countries as well. Can't y'all hear my dog, right? Sorry. Every time I get going, Can't. 1 second. Kane, wake up. Wake up. My dog was snoring. Okay. So right now, they're saying that they're trying to push it to 4.5% by the end of next year. And we know that the feds are hitting this interest rate fairly aggressively because they're trying to fight inflation. But when you do things like pump 80% of the US money into the economy within the past 2 years, these are just the type of things that's going to happen, right? And so we as investors, we as consumers, we have to try to position ourselves as best we can with what's going on. One way that we can do this is obviously, just get prepared on the financial end, save as much money as you can that, in your emergency fund, focus on paying down debts. But I personally would not say use all your money to pay down debts, because then if something happens, you're just going to get into more debt. I would also say start to decide the amount of money that you have that you can put in the markets. I have people that come and ask me and say, oh, well, should we just wait until the bottom to invest? Well, that is a two-part question, because if you're talking about investing into long-term portfolios, such as like low risk ones that have the potential of having a high return, like index funds, which I'm a huge fan of, I think it's an awesome way to build wealth long-term, then no, I wouldn't say wait for the bottom, because at the end of the day, even though the S&P 500 has not been performing well over the past year, if you look at it since its inception, it's still going strong. If you look at the S&P 500 since its start, it's still very much in an uptrend, y'all. However, this past year, it has been pretty rough, right? In the past 2 days, people are taking on the assumption that, oh, okay, well, we're getting ready to transition out of how it's been performing over the past year. And that's just simply not the case. It is my strong belief that the S&P 500 and the Dow will continue on a downtrend once these rallies are over, and that we will be experiencing some rough terrain for the next year or so. However, if you are investing month over month and you are putting it into a low risk, high return type of portfolio, then I think that that is a smart investment to do. Where I would caution you is individually investing into stocks and you not knowing what you need to do when you're investing in them, right? So there was a conversation at the meetup in New Orleans, and one of the ladies was like, so should I take advantage of the fact that Bed Bath & Beyond shares have gone down so much and get involved with them? And one of the other speakers mentioned, hey, just because they're a popular company doesn't mean that they're going to continue to do well or do well over time, right? Case in point, JCPenney is one of them. So another one that she mentioned was Hertz. So what I would say is, if you're someone who's like, you want to get individually invested into stocks, like you're looking at specific companies, you're saying you want to buy whole shares of these companies, there's a few things you need to be looking at. And I've said this several times over, but please make sure that you're not only looking at, the news that you read about the company, but you're also looking at how much cash they have on hand. You're looking at their balance sheet. You need to know, as a shareholder, what you're walking away with if the company does go belly up. You also need to see on the technical side, you need to see how the company has been performing historically, right? That past data is going to help you predict future movements in the market. It's going to help you predict future positions in whatever you're looking to invest into. But if you don't understand fundamental analysis and you don't understand technical analysis, it's not going to serve you very well to be individually invested into companies just because you like them. I say all the time, if you're a consumer of the company, you should look to also be an owner of the company. I say that especially with companies like Apple, right? Apple has a $1 trillion valuation. Okay, they're expanding into different sectors. And as well as Apple is not only a long-term position that you can have in the market, because you can see since like 2018, even with its steady fluctuations, Apple overall has continued to go in an uptrend. Okay, but you can also see on a seasonal standpoint since like 2019, 2020, that between the months of late June until late August, each of those months, Apple has had increases, right, in their positions, their shares have gone up. And then come September, when a new product is released, their shares sell off. This is something that you can do seasonally. Can also be a long-term position. Okay, so when you're talking about everything that's going on in the economy right now, and you're like, sis, what do I do? If you're a new investor, the best thing that you can do right now is take advantage of low risk, high return styles of investing. Okay, that's index funds, that's I bonds. Okay, because right now it's still at a 9.62% on their returns, minimum $50, maximum $10,000. You have to have it in there for a minimum of a year. You take it out before the 5-year mark, you lose 3 months worth of that growth. However, it's still outpacing the rate of inflation. Inflation's at an 8.5%. Okay. Index funds, traditionally the S&P 500 has had a return of 10.5%. And I see a lot of people put their money into savings accounts thinking that that's what they want to do long term. But whole while, if it's not outpacing the rate of inflation, you're losing value on your dollar day in and day out. So if your money is not in a savings account for a specific design purpose, such as a birthday, a holiday, emergency fund, car maintenance, if it's not in there for those specific reasons, then you need to be looking at making some other decisions with your money, i.e., some long-term investment portfolios. Okay, because one thing especially that I love about just Roth IRAs in general is that you can take out of the contributions without penalty, but you're still being able to take advantage of the growth of the market. Okay, so if you're thinking about getting into investing into index funds and you're wondering where you need to go to invest into these, right? Because a lot of people say, oh, we'll go invest in SP 500. But then it's like, all right, sis, well, where do I go to invest into it, right? So I love Fidelity. And in the last reel that I post, I showed you guys there are three type of investments that you can get into that essentially peg, okay, the S&P 500. And these three have no minimums in order to invest. So you can start out that bad boy with $1 if you want to. No minimums to get this started. So there's no reason why any of you who are tuned in via the live stream, via IG Live, why you shouldn't have this started. Okay, so you have Schwab S&P 500 index fund. Okay, you can get that through Charles Schwab. Now their fees is 0.02%. Okay, Fidelity 500 index fund. That's FXAIX, no minimums, 0.015%. And then Fidelity Zero Large Cap Index, FNILX, no minimum, no fee. Okay. So what the minimum is, so what I'm referring to when I say minimum, I'm talking about what you're required to put into the account so that you can open it, right? So like, we can even talk about this from a stock perspective. So I have a few stock portfolios, right? And a couple of them are I have self-managed accounts. So if you go to your bank and you say you want to open up a you want to open up a stock portfolio, they're going to tell you that you have to have a managed one, and they're going to want you to have anywhere between like $10,000 to $25,000 in that account. The reason why they do this is because they have someone who manages it, who makes money off of that portfolio. Well, you can open up your own self-managed one where you're going in and individually selecting the investments that you want to have ownership over those shares. So one of the things that I did is I went to my bank. So whether you bank with Bank of America, Chase, Wells Fargo, it's a brick and mortar location. Go on their website, just go to the investments tab and say that you want to open a brokerage account. Let them know it's self-managed. The self-managed accounts typically don't have any minimums. Okay. The self-managed ones typically don't have any minimums, but people usually start with like $100 in those. One of the things that I did was I went and I broke down the components of the NASDAQ. All right. So I looked at all the companies that was on there. I determined which ones fit within my budget. From there, I started to read the fundamentals of the company, and then I started to look at the technicals of the company. Excuse me. And then I started to look at the technicals of the company. I made strategic decisions based off of the fact that I understood fundamental analysis and I understood technical analysis, and I made some very wise investment decisions because of that. If you're a new investor and you don't understand what those are or what to look for or how to look for it, obviously, you know, I've taught a couple of classes on this already. The recording is available and is broken down as a course, and you also have the resources as well. So excuse me. So it's $39.99 if y'all want access to the class. It's the link in my bio. You literally get everything that everyone else got, all the physical resources, all like it's the entire breakdown. So you won't walk out not having a solid understanding of fundamental and technical analysis in the stock market. I'm sorry, 1 second. Whew, okay. Alrighty. So somebody said, what do you think will happen to Apple stock today or this week? So I actually have not looked at Apple today. I did look at it last week, but I have not taken a look at Apple today. From last time I looked at Apple and we did our chart markups, I was saying it could potentially go to $143 a share because at that point it was still coming down. But I haven't looked at it recently, so I need to go back and take a look at it. But I will definitely let you know. So thanks for asking that question, Alex. I'll do some research on it and I'll probably post a reel about it because I really like Apple. Okay, let's see. So let me see. Was there anything else I wanted to talk about? No, I think that's it, y'all. Listen, investing doesn't have to be difficult. All right. People like overcomplicate this thing all the time because they start getting into, you know, understanding candlesticks and chart patterns and you know, all those things. And it's not necessary when you're first starting out. When you're first starting out, the things that you need to understand is pull up a company. You can pull them up through the NASDAQ website, or you can simply just Google said company. So you can Google Apple quarterly earning reports, pull those up. You definitely need to see what their assets are, what their liabilities are, how those balance out. So the balance sheet is going to tell you that. You need to check their income statement. But more importantly, I would be looking to see if the company has been audited by a third party. Reason being is because sometimes companies can fluff their numbers a bit, but if you have a third party come in and audit them, they can't hide from that, right? And then the other thing is the only reason why you would really need to look at technical analysis, especially as a new investor, is when you're determining your exit strategy on a particular investment. So that's why I always said, like, hey, if you're going to get into this investment game when you're individually investing into stocks, understand that the risk is much higher. Okay, it's high risk investing with the stock market, it's high risk investing with the foreign exchange market, it's high risk investing with cryptocurrency. All of those are high risk styles of investing. Low risk, high reward forms is when we're looking at index funds, mutual funds, right? Is when we're looking at investing into bonds. These things don't have a lot of risk that are attached to them. Okay. So just don't complicate it. Somebody said I sound like the org. That's cool. Thank you. Okay. So just do not overcomplicate this. Keep it simple. That's it. Ask yourself, is the company broke? Are they going broke? Do they have a good amount of money that's going to take them through the recession? Look at the language of how the companies are speaking. There's a lot of companies that are starting to do hiring freezes and layoffs, okay? Apple, Google, Meta, they've already announced this months ago that they were going to be doing hiring freezes. Do you know why they're coming mid 2023? Is because CFOs have come out and they've stated that we're really not going to feel the effects of this recession until mid 2023. So these larger companies are starting to dial back. When the larger companies dial back, it affects the smaller companies. Okay. It affects people's households because people still have to work to pay their bills, to feed their family. Okay. And when companies are not making money, the employees are affected because their focus is their bottom line. All right. So when that happens, that's less people shopping. Okay. That's less money being turned over in our economy. All right. That means that our GDP is more than likely going to continue to go down, our gross domestic product. Okay. So just pay attention. All of this stuff is a ripple effect. It all is a ripple effect. And you have the opportunity to prepare. I can't necessarily say ahead of time because we're already feeling the effects of a lot of the things that's going on with the economy, but you still have time to prepare before we really, really get into the thick of it, because we're not really there yet. We're really, in my personal opinion, I really don't think we're in the thick of it yet. I think the thick of it is going to happen in mid 2023 because there's been too many companies that have been coming out saying things, too many CFOs that have been coming out and saying things for me to say like, oh, everything's going to be hunky dory. I don't think so, y'all. I think we really finna get into it. Okay, yeah, and somebody mentioned, or Val, hey Val mentioned meat prices have doubled, and we haven't even seen the height of that. Because I've already said this, y'all, it's more expensive for them to feed them now. So the more expensive it is for the farmers to feed them, the more they're going to charge the butchers, the more the butchers are going to charge, the grocery stores. I don't know the actual correct order, but at the end of the day, it's going to end up hitting our pockets, right? So you see where now beef has doubled and those type of things, that stuff is going right back up and probably higher. So if you have the opportunity to bring in some additional income, I would do that. If you have the opportunity to put aside money for saving and investing, I would do that. I would definitely put aside money to invest 100%. 110%. I would not miss out on this opportunity to get positioned into the market. They say this all the time, that millionaires are made during a recession. Now, the reason why they say this is because you can position yourself well in the market if you are moving strategically. Okay. Now, someone said, if we are potentially getting ready to face a depression, then wouldn't the stock market be affected by that? Yes, all markets are going to be affected by that. But that's why I said that if you're a new investor, it would be a great opportunity for you to just begin to invest in index funds, low risk, high return styles of investing. Have a set amount month over month that you can put into the market and take advantage of compounding interest, right? If you're looking to individually invest into stocks, this would be a great opportunity for you to be learning about how to individually invest into stocks. So when these companies really start to hit these deep shifts, then you can position yourself individually. That is what I would do. Okay, so I've got my eye on a couple of companies, but even still, y'all, just because some companies aren't doing well, that doesn't mean all companies aren't doing well. We've got a big shift happening right now with energy. Okay, we've had a lot of companies come out, talk about how they're moving solely to EV and how they plan on doing that by California is moving solely to EV by 2050. You've got Honda, who's only going to be doing EV vehicles by 2035. And recently, when I was in New Orleans at my hotel room, every commercial was about EV something. Like almost every other commercial was like supplement pills and EV. That was like the whole thing. So we can see that there's a shift happening. And then they just came out and said that they were giving tax credits to everyone who was a homeowner who was switching over to energy efficient appliances, right? Solar panels, so there's still opportunity to invest. Just because some companies aren't going to do well, that doesn't mean that all companies aren't going to do well. And you have to find where you should position yourself. I think it'll be a phenomenal opportunity to get into energy stocks, solar stocks, right? I think that would be a wonderful thing for y'all to do. And I have a list of them. I know that I did a reel on that. So there is a list of them that I gave you guys that you should go check out. But don't sleep on it. Don't get fearful of the market. There's no place for emotions in the market. If you're fearful of the market, then don't invest because you're guaranteed to lose money. What you have to depend on is data. Okay? Emotional intelligence is one of the strongest things, one of the strongest assets that you can have when it comes to investing. And I don't know if you guys have gotten this book from me or not yet, but The Intelligent Investor is a book that I've been giving out. So if you haven't gotten that one from me yet, just DM me and I'll get it over to you because I'm about to hop off. If you are watching from a different live stream, find me on Instagram because that's where I'm most active, and I will DM you the Intelligent Investor. Want to make sure you guys get access to that. Also, okay, if you are a new investor, don't forget I do have the class. It's up. You can pay for it, get immediate access to it. Feel free to ask me any questions that you have. You have a support line there as well. But that one's $39.99 if you're a new investor and you want help really getting a clear understanding of the market. And then the other thing is I do have a freebies vault, but that freebies vault is going away. Okay. So in the freebies vault, there's like some PDF, there's some templates in there and everything. It's in the link in my bio if you guys want it. But that is going away within the next 7 days. Oh, thank you, Ruth. Ruth said class was amazing. Yeah, we had people from 5 different countries in that class. 5 different countries. It was amazing. It was we had a total of over 300 people took the class. I haven't had anyone that didn't leave a positive review, and it was 5 people from 5 different countries that attended. So it was amazing. It was absolutely amazing. Okay. But if you're a Boujee bestie, last thing, y'all, if you're a Boujee bestie, you know that any class I teach, you get it for free. We do have workshops every single Monday. Every Wednesday, we have accountability calls. And every Friday, we have financial literacy game nights where you have an opportunity to win money for learning about financial literacy, which is really cool. And then once a month, we give money to a charity that focuses on women and children. And once a month, we give cash boosters to someone within our community to help them with a debt repayment, their savings goal, or to put in an investment account. So the community is $30 a month, but that price is also going to be increasing soon because of all the value that's in there. So if you'd like to become a Boujee bestie, you're more than welcome. You'll get access to the stock class and all the other coursework that's in there and the community. And if not, I definitely encourage you to take the class. And if not, I definitely encourage you to grab your freebies. But don't forget to DM me about the book. Okay. All right. Well, everything is available. So, Mars Queen, you're gonna have to DM me because I don't get to keep the comments here. Oh my gosh, this is so funny. Somebody I went to college with, y'all. Literally, I'm 34, so college was so long ago. They said you still owe me $20. Dennis, you are so funny. You still owe me $20. I got you. Okay. All right, y'all, have a wonderful evening. That's going to wrap it up for me today. Thank you so much for everybody who bought a badge. And for all of you who purchased a book, I will be sending them out first thing in the morning. Y'all have a great night.